Hi, everyone. Good afternoon, and thanks very much for joining us again. Um, Today, we have something a bit different because we have one of Kepler's own in-house managers joining us to give a presentation to you. So, Ed Butchart, who's going to be speaking, is the portfolio manager for two funds that Kepler oversees, which invest in emerging markets. So perhaps unsurprisingly, then the presentation then is going to be on the outlook for emerging markets. I think it will probably be about 35, 40 minutes. So as with all the other presentations, we should have some time for Q&A at the end. So if you do have any questions, please pop them in the box on the right, and we'll endeavor to answer them at the end. So Ed, I will hand over to you.
Thanks very much, David. Good afternoon, everybody. Thanks for your time today. So the term emerging markets was first coined back in 1981, but it took quite a while before a useful index was created. So in fact, the end of last year marked the 35th anniversary of the inception of what's now taken as pretty much the standard benchmark for the asset class, namely the MSCI index. So it seems an apposite moment to take stock and ask, how has the asset class fared over that time, and what conclusions might we draw for the future? So this first chart reports annualized total returns for various geographies on the horizontal axis, along with volatility on the vertical axis. Over the 35 years ending late last year, EM equities delivered a 9.5% annualized dollar return. That's better than that's achieved by the overall MSCI World benchmark, which generated a 7.9% return. So in that sense, EM has outperformed, but it came with significantly higher volatility, 22% for EM compared with 15% for the MSCI World Index. And the chart makes it very clear that the outperformance comes thanks to EM beating European equities, and in particular Japanese equities, which of course started this period very much in bubble territory. In contrast, US equities generated somewhat higher annualized total returns than EM, and combined that with notably lower volatility. The EM should have been a more volatile asset class over the last 3.5 decades would not, I think, have surprised the investors of 35 years ago. But that it should lag the US is, I think it's fair to say, somewhat disappointing compared to original expectations. However, an equally important observation from the last 35 years of history is that emerging markets are a biblical asset class. They go through prolonged periods of feast and famine. And this next chart really illustrates that. It shows the performance of the emerging markets benchmark relative to both global equities, that's the blue line, and the US, the red line. So what you can clearly see here is firstly a huge boom in the early 1990s, then a series of macro crises in the late 1990s, when effectively all of the previous outperformance was lost. The next decade then proves to be absolutely stellar for emerging market assets, but then relative performance peaks sometime in the early 2010s, and EM has generally been lagging behind ever since, notwithstanding the occasional sharp cyclical upswing. Now, interestingly, these sort of pronounced swings in relative performance seem to be an enduring characteristic of the world's more peripheral economies. A few years ago, some academics at London Business School created a synthetic EM index that they took all the way back to 1900 using the same inclusion rules employed today. And they saw the same feasts and famines in earlier periods. So, for example, the 1920s were bad for emerging markets, as they would then have been comprised, whereas the 1930s were relatively good, certainly compared to developed markets. The 1940s are very poor, not least due to military defeats and communist revolutions. But then the 1960s and the 1970s are pretty good. And in fact, if you go back even further, the same phenomenon shows up in the late 19th century, with decades in which money poured in to fund railway construction in developing countries, followed by decades in which enthusiasm was distinctly subdued. So what all of this means is that the exact dates you choose to measure long-term performance in EM matters hugely. And just to emphasize that point, I mean, if I'd run the long-term performance chart after 25 years instead of 35 years, I'd have got this next scatter. So we see the same pecking order within developed markets, the US ahead of Europe, Japan well behind, but now EM leapfrogs ahead of the US with a higher return to at least partially compensate for that higher volatility. So the point is that with the last 10 years having seen prolonged famine in EM, this is a particularly disadvantageous moment to be taking a snapshot of long-term performance and drawing definitive conclusions from that. So the obvious question is, what drives these periods of feast and famine? And an obvious place to start is valuation. So this next chart plots the rolling 12-month forward P ratio for EM, that's the blue line, and for the US, the red, since it's the US that EM has most obviously been competing with for relative performance honors over the years. Back in 2010, EM and the US were trading on pretty much the same forward multiple. EM in absolute terms wasn't a great deal more expensive than it is today, roughly 12 times earnings. But the US was looking pretty reasonably valued versus its history. So part of the EM underperformance since then has been the near doubling in the 12-month forward P ratio in the US. And at the same time, there's also a huge profits boom in the US, so that the denominator of the P ratio has been rising very strongly as well. That's what this next chart shows, where the blue line shows you that EM prospective earnings actually been running well ahead of the US, which is the red line, for right up until sort of 2010 and beyond. But since then, US earnings have just roared upwards and ahead. So a big part of the reason why the global periphery lagged behind in the last decade was because there was a boom at the very core, which frankly disinclined capital to go looking for ideas further afield. The standard mantra was, why invest in emerging markets when you can just buy the FANG stocks, for example. It didn't help, though, that at the same time, emerging market earnings were also running out of steam. And the problem here was a marked slowing in the pace of emerging markets' real GDP growth, from a breakneck sort of 7.4% in 2010 to roughly half that pace just before COVID struck. That partly stemmed from China, which began its structural growth slowdown a decade or so ago. It was around then that it reached the so-called Lewis tipping point, running out of surplus rural labor that could be easily transferred into more productive manufacturing. And it was around then that China's immense property replacement cycle began to run out of steam, as well as the initial trading gains of China having joined the WTO. So China, which had been growing well in excess of 10% a year, slowed to more like 5%. And at the same time, a number of other emerging economies that had been experiencing strong credit and investment booms got themselves into macroeconomic trouble, forcing them to put the brakes on in order to fix balance sheet problems. And that's a process that took a number of years to work out. And this growth slowdown caught out companies that were assuming the good times would last. There was an obvious supply overhang in commodities, for example. Industrial stocks found themselves with excess capacity, and banks had to put through a whole load of provisions. So the impact of all this shows up when we look at profit margins. Prior to the global financial crisis, EM, the blue line, and the US, the red line, had roughly the same level of profit margins. Since then, EM margins have waxed and waned, but in general have been relatively sluggish. Meanwhile, the US economy embarked on a steady, prolonged economic expansion, recovering from the depths of the housing crash, aided by loose monetary policy, occasional big fiscal stimulus, and with plenty of slack to use up, and wages quiescent and interest rates unusually low, there was also a sustained improvement in profit margins to levels that are now very high by historic standards. So these developments are why the simple 12-month forward P ratio doesn't necessarily tell the full story when it comes to assessing the equity investment opportunity in any particular jurisdiction, and why long-term forecasters tend to prefer some kind of cyclically adjusted P ratio, which makes allowances for countries being at different points in their economic and profit cycles. And when we look at the cyclically adjusted P ratio for EM, the blue line, and the US, the red line, we see a far more striking divergence in valuations. EM is on 10.3 times, whereas the US is on 23.3 times, capturing the fact that margins there are unusually high at present. In short, a major reason why EM has lagged behind in the last decade or so is that it got a bit overheated in the immediate aftermath of the global financial crisis, and many economies had to go through an adjustment process. At the same time, the US came out of 2008 looking pretty cheap versus its history, and with the potential to significantly boost profits because there was so much spare capacity in the system, especially in the labor market. Fast forward, in other words, emerging markets in the US were at completely opposite ends of the investment cycle, and opportunity favored the core over the peripheral. Now, as I said, if we now fast forward to today, pretty much all of that's been reversed. It's true, China continues to face structural growth headwinds, not least from an aging population and from a growing American attempt to deprive it of the most advanced technologies. And there's also an obvious debt overhang that has to be worked off in the quasi-government sector over the next few years. But much of the growth reset, I would argue, has already happened. And certainly companies that sell into China have had the opportunity to recalibrate for a more conservative outlook. And elsewhere in EM, economies have generally had very subdued credit cycles and subdued domestic demand backdrops for quite some time now. Corporates that were over-levered have largely fixed their balance sheets. So the starting point in EM is that there aren't too many major macro imbalances. And that shows up in growth forecasts. So, for example, the IMF sees EM growing about 2.5 percentage points per annum more than DM, developed markets, in the next 5 years, compared to just 0.5 percentage point in the last 5 years. And meanwhile, Wall Street looks expensive even before we make allowance for the potential for margins to start to get squeezed in a late cycle economy, seeing much stronger wage growth and much higher interest rates than we've been used to for a long time. Now, another obvious factor driving these phases of feast and famine in EM is the dollar. So in this chart, the blue line is EM versus global equities, and the red line is the trade-weighted dollar. What we're seeing here is generally an inverse relationship in the strength of the dollar and the relative performance of emerging market equities. A strong dollar, such as we've had for much of the last decade or more, has generally been a headwind for EM relative performance. And interestingly, you see something similar in earlier periods. So in the 1970s, for example, a decade of dollar weakness, that was an era in which EM-like assets, in other words, less developed countries, performed pretty strongly. Whereas the 1980s saw a strong dollar, at least in the first half of that decade, which coincided with the whole Latin American debt crisis. So dollar weakness tends to signal that for one reason or another, investors are seeing better opportunities outside US markets, perhaps because of the relative valuations on offer. and they're allocating their capital accordingly. But the inverse relationship also reflects the fact that many emerging market countries are resource producers, and commodities often perform well when the dollar is weak. Now, the reason why all of this particularly matters at the moment is that the dollar actually looks quite expensive in a historical context. So this next chart plots the real exchange rate for the US. In other words, the exchange rate correcting for inflation differentials between the US and its trading partners. The blue line here is the broad real exchange rate encompassing a full range of America's trading partners. And that's kind of roughly at the same levels as it was in the early 2000s. And the red line is the narrow real exchange rate, just focusing on core trading partners. And this particular measure is now homing in on the previous peak of the 1980s, which culminated in the Plaza Accord, which actively sought to engineer a weaker dollar. So in summary, in a 50-year context, not only does the dollar look expensive, it's increasingly looking very expensive. And crucially, the dollar real exchange rate mean reverts in the long run. That's what this chart makes very clear. In fact, it does more than that. It usually swings from one extreme to another, taking the best part of a decade or so to do so. So the extremely high dollar valuations of the mid-1980s or the early 2000s then led to prolonged periods of dollar weakness, and the extremely low valuations of the early 1990s and the early 2010s led to prolonged periods of strength. So this really is one of the key takeaways of my presentation. We're sowing the seeds for a potential game changer in global markets, namely a shift in the dollar from secular bull market to secular bear market. And that's a shift that history suggests should be positive for emerging market assets. So that's how we're seeing the overall big picture for EM. Wall Street's expensive and the dollar is expensive. And both suggest that global capital should increasingly look to opportunities elsewhere, including EM. So I now want to turn to the opportunities within emerging markets. And there are three main topics I'm going to address in the rest of my time. Firstly, where are the most interesting, most enduring growth opportunities in EM right now? Secondly, what's the outlook for commodities and how best to play that theme? And thirdly, what to do with China. So first up, this next chart sets out how we think about the potential for growth in each country over the coming decade. And firstly, I should stress that as a dollar-based investor, it's dollar GDP that I really care about. It's no use an economy growing at 5% real GDP growth if its currency depreciates by 10%. That amounts to a contraction in dollar terms that's likely to impact dollar share prices. So I'm making a judgment here both on real GDP growth potential and the outlook for the real exchange rate. So for the US, for example, I'm assuming 2% real GDP growth and 2.5% inflation, although in practice it may well be a little bit less growth and a little bit more inflation. But crucially, if the real value of the dollar mean reverts in the coming years, that'll create a tailwind for dollar GDP growth pretty much everywhere else. So that's actually supportive of European dollar GDP growth assumptions, even if you make relatively muted assumptions about real GDP in the continent. But still stronger dollar GDP growth should come from emerging market countries. Yet interestingly, in our view at least, not especially from China. As I've already said, potential real GDP growth in China has been slowing for quite some time now. And I don't really see anything that's likely to change that. But we also think the renminbi is one of the few EM currencies that doesn't look especially cheap at present. And there's a large pool of domestic savings that would move into foreign currency assets if capital controls were ever relaxed, and often does try, in fact, to find ways to leak out of the country one way or the other. So all that results in a dollar GDP growth assumption for China that puts it roughly in the middle of the pack here, rather than being a standout, as it has been in the past. Instead, we think that the countries that will grow the fastest will have some combination of the following three characteristics. Firstly, it helps to have a low starting point in terms of GDP per capita, so that there's the potential for fairly easy catch-up growth. Secondly, you need a reasonable institutional structure, rule of law, functioning government, improving public infrastructure, and so forth. And thirdly, you need a trade angle, such as close ties with a rich neighbour that you're integrating more with, or being a potential beneficiary of companies seeking to diversify their supply chains, most obviously right now away from China. And given all this, we think some of the strongest growth potentials are actually likely to come from the ASEAN region, countries like Indonesia, Vietnam, the Philippines. In Indonesia, for example, bank credit is still only 40% of GDP, so there remains a lot of scope for fairly plain vanilla financial sector deepening. India also stands out in this chart. And the great frustration with India has been that market rigidities combined with muddled political priorities, they've really sort of prevented the country from making the most of its pool of cheap labour. But to be fair, Prime Minister Modi has made some progress in streamlining the bureaucracy. And it's interesting to see someone like Apple say that they're planning to shift a quarter of global iPhone production to India by the middle of this decade. Now, despite already being reasonably developed, Eastern European countries, like Poland, for example, should also post good growth rates over the next few years as they continue to integrate with the rest of the EU. In fact, on current trends, in less than 20 years, the 11 once communist countries now in the EU will have reached the same average per capita income as the EU's southern bloc. And strictly speaking, Mexico should also be benefiting from the same kind of convergence effect that East Europe is exploiting, given its potential to integrate more and more with the US. But for years, a fairly oligopolistic economy and poor central governance have hampered its growth potential. And despite the fact that the current president is distinctly dirigiste and unorthodox, Mexico is in fact at last enjoying a bit of an investment upturn as more and more American companies set up operations in the north of Mexico as part of the diversification of their supply chains, a process that's been branded friend-shoring. So, for example, just this month, Tesla announced that they plan to build the world's largest EV factory in Mexico. Importantly, in the kind of countries I've just mentioned, it's also possible to find good companies to invest in, businesses able to take advantage of the growth opportunity and generate shareholder value as a result. In some instances, that takes the form of well-run banks with obvious sort of competitive advantages. So that would be names like HDFC Bank in India, or Banks Central Asia and Rakyat in Indonesia, and Banorte in Mexico. Then there are consumer-facing names still riding the modernization of retail and the expansion of the middle class. Companies such as the proximity supermarket chain Dino in Poland, or Walmart's subsidiary in Mexico. And these companies can still be acquired at reasonable valuations in our view. And so for as long as that state of affairs endures, we would expect to continue to hold them in our portfolios. You can think of these as our sort of buy and hold assets. On to my second topic, commodities. This next chart reminds us of how important commodity exports are to many emerging market countries. It's particularly true of the Middle East, where net commodity exports are often in excess of 20% of GDP, and to a slightly lesser effect in South America and South Africa, where net commodity exports are in the region of 5 to 15% of GDP. Now, whilst from a near-term perspective, we have some obvious macro headwinds that need to be digested globally, further out, we take a pretty upbeat view on the outlook for commodities over the coming decade. So And firstly, the fact that the dollar is expensive and ripe for mean reversion is a justification for this, given that commodities are typically priced in dollars and do much better when the dollar's weak. But in addition, the last few years have seen clear underinvestment in commodities, as this next chart shows for both the oil and gas sector and the metals and mining sector. Obviously, the world is keen to wean itself off oil as soon as it can, but that isn't going to happen overnight. And in the meantime, new investment is very subdued for ESG and other reasons. And for the base metals, we're actively going to need more copper, aluminium, and nickel if the world economy is to decarbonize and focus on renewables. The further we look out this decade, the bigger the shortfall looks between projected demand and projected supply, given how few new projects have been greenlit in recent years. So there's a decent chance that commodities will perform far better than, say, the S&P in the next decade. However, I want to advance the proposition that within EM, commodity stocks are not necessarily the optimal way to play a potential commodity boom. In emerging markets, resource companies are often state-owned and have competing objectives rather than being wholly focused on their shareholders. Anyone paying even a passing interest in ESG also needs to worry about the risks of environmental damage, treatment of local communities, issues of health and safety, and corruption risks. More broadly, my observation from the last great resources boom would be that commodity stocks often become less good proxies for commodity prices the stronger the bull market gets. Workers go on strike to demand higher wages. Governments get greedy and change the rules of the game. Local currencies strengthen, hurting margins. And CEOs often get hubristic and do silly things at the top of the cycle. That said, a commodity boom is a tide that can raise all boats in a resource-producing country. When commodity prices rise, the terms of trade and external balances tend to strengthen. Currencies appreciate. Central banks can allow interest rates to fall and domestic demand to grow without worrying unduly about balance payments concerns. Governments have more tax revenues to spend. In short, it's a pretty good time to be a domestic-facing business in such a country. And here we can find companies less obviously impacted by the potential downsides of a resources boom. That's why back in the days when Russia was still investable, we often preferred to own Sberbank when we were bullish on the oil price rather than the oil companies themselves. And why the best opportunities in Brazil over the coming decade are likely to be more domestic oriented in our view. Right now, we like Sendas, which is a cash and carry retailer, and TOTUS, an IT services company. But one of the really nice things about the Brazilian stock market is it's constantly refreshing itself, bringing new dynamic companies to the marketplace. That's what the Middle East also needs. And to be fair, this is starting to happen in, say, Saudi Arabia, as part of a broader plan to modernize the economy and make it less oil dependent. The region's share of our equity investment universe is on the rise. And so we've certainly been paying it more attention. But at present, we do still struggle rather to find companies there that really excite us. My final topic is what to do with China. This next chart, the red line here, reminds us that China has been the great success story as far as the whole concept of emerging markets is concerned. It's truly emerged, its GDP per capita rising by a factor of 25 since 1994. It's an extraordinary success story. Now, if you'd have known that was going to happen, you'd have surely put all your money into Chinese equities back in 1994. So how would you have fared? Well, firstly, if you'd somehow managed to get exposure to mainland A shares, the purple one here, you'd have had a pretty volatile roller coaster ride, but at the end of it, you'd have generated a 4% annual gain, relatively modest, all things considered. If you'd have bought the MSCI China index, the black line, you'd have made no money at all. And if you'd have bought H shares, in many ways, the most obvious thing to have done, the blue line shows that you would have actually lost money over this time frame. It's a simply stunning disconnect, and frankly, a big part of the reason why overall EM performance has disappointed relative to those initially lofty expectations. So what's going on? It's partly an issue that affects all stock markets. They can often struggle to turn GDP growth into equity returns. Stock market composition doesn't always offer you direct exposure to the areas where the growth is most obviously coming from. And even when it does, the problem is that chasing the revenue opportunity can often come at the expense of profit margins. And growth requires CapEx, which could possibly have to be funded by equity dilution. And CapEx only boosts share prices if it's NPV accretive, of which there's no automatic guarantee. And to be clear, this is not just a China or even an emerging markets problem. Research by Hendrik Bessenbinder of Arizona State University found that the majority of listed American companies underperform T-bills over their lifetime, and that the entire net gain in the US stock market since 1926 was attributable to just 4% of listed stocks. Most companies, Bessenbinder showed, are distinctly average. And that insight has really impacted how we think about stock selection for a number of years now. On the one hand, we look for what we call compounders, businesses with a sustainable competitive advantage that will be hard to erode. These are the kind of companies that we think will be able to turn a revenue growth opportunity into shareholder value creation. And for these companies, we think a long-term viewpoint is justified. So we're valuing them with DCFs. And if there's a sufficient margin of safety, we invest in them with a long-term mindset. These kind of investments very much form the bedrock of our portfolios. But for everything else, long-term forecasting frankly makes no sense, because you've no real insight about what the long term is going to hold for these companies. Similarly, a buy and hold investment mentality doesn't really work because there's no guarantee of sustained profits growth. But it can be profitable to rent such stocks if you can be confident that their profits will rise strongly for at least the next year or two, perhaps because it's a tech hardware company that makes a widget that's in particularly short supply at the moment, or a domestic cyclical at the onset of an economic upturn. When you crunch the numbers, you judge that the market's been slow to spot this inflection point, so you can hold the stock for a period of time whilst you wait for the market to catch up. And then you sell and move on, since there's a good chance that the profits upturn will eventually run out of steam. Now, what's interesting is that the emerging markets that we look at seem to vary in their propensity to produce compounder-like businesses. A lot depends, of course, on whether the stock market comprises more consumer-facing companies or more export-oriented companies, because the latter group typically tends to be more cyclical in nature, whereas the former group is more likely usually to throw up compounders. But it also helps if industry structure in the country tends to be a bit oligopolistic, such as in Mexico, for example, or the state of infrastructure is poor, or if the country is an archipelago. So the practicalities of building a national footprint are challenging, as in Indonesia. Or the country is quite bureaucratic, bogged down by red tape and regulation, as in India. And the cost of capital is on the high side, as it is in all these countries just mentioned. On the one hand, such inefficiencies tend to mean that the economy doesn't quite grow as rapidly as it might have done. But for the equity investor, the important point is that these inefficiencies make for entry barriers and profit moats. So it's the little imperfections in capitalism that really help to create the long-term opportunities for stock market investors. On the other hand, our judgment is that China is one of those countries that tends not to generate a high proportion of compounders within their stock markets. There are plenty of state-owned companies, for example, who have competing priorities and for whom shareholder value creation is certainly not the be-all and end-all. There are sectors where demand is in obvious structural decline, and industry consolidation is going to be needed before anyone can make a sustainable profit. Then there are other sectors where demand is obviously growing structurally, not least because the government wants it to, but where the objective is boosting national capabilities rather than necessarily maximizing profits. The Chinese government is pretty wary of monopoly power and can turn on companies whose growing profits might give them political influence, as we've seen in the internet sector in recent years. But the broader point is what we consider to be the great irony of China. A country run by a communist party has one of the most intensely capitalistic economies in the world. You invent a great product, someone copies it. You build a great business, someone goes out and raises funding to replicate it. It's extraordinarily difficult to build a sustainable moat that can generate consistently high returns on capital over time. Profits are competed away sooner rather than later. Given all that, how should we deal with China? Firstly, you should look for the few exceptions that are able to build a moat, the compounders in other words, and focus the long-term investments you want to make in the country on those kind of names. So for example, we think that a company called China Menu Dairy falls into that category, sells milk and dairy products, which is a structurally underpenetrated market, and it's part of a duopoly where barriers to entry have been created by brand marketing and vertical integration. It also helps that COVID headwinds have depressed the multiple for the stock. So right now is actually a particularly attractive entry point for the longer term. But for everything else, you really need to adopt more of a trader's mentality, not an investor's mindset. China's not a market, we would argue, where you want to pre-commit that you'll always have a big slug of your assets invested there on a long-term basis. And political and geopolitical considerations surely only strengthen the conclusion that one should approach the Chinese market very pragmatically. Now, as it happens, having been quite wary on China since mid-2020, we think the market does now currently represent quite an interesting trading opportunity. Trading rallies usually occur when the market's initially pretty cheap, as it is now, with a forward PE of less than 11 times, and a number of companies that we've analysed appearing to be particularly attractively valued. Trading rallies usually occur when the market's underowned and unloved, and having broken below its 2008 lows last year, China is certainly that. Trading rallies usually occur when the economy is just starting to recover and policymakers very much want it to continue to do so. And all these boxes are being ticked right now. It's important to realize China was in a recession last year if you measured economic activity properly. The official GDP data certainly didn't show that. That's the yellow line on this chart. That reported a 3% growth rate last year, but a composite measure based on less obviously manipulated data, the blue line, contracted. That's why zero COVID was scrapped and why the government is making peace with the private sector, at least for now. There's a coordinated attempt to stimulate economic revival this year. And there are some tentative signs that that effort is beginning to gain traction. For example, February saw the first evidence of credit demand starting to pick up as the COVID wave faded and life began to get back to normal. The credit impulse, which was the monthly change in the pace of credit growth, turned positive for the first time since 2020, as the black bars here show. And that's something that historically has often been supportive of much better stock market performance, the blue line. So there's an argument that China offers a differentiated recovery story this year, as the rest of the world sees policy tightening designed to engineer a growth slowdown. But it's a trade that requires pragmatic risk management, given ongoing geopolitical noise and unpredictable domestic politics. So, summing up, the dollar's expensive, and the next decade's likely to see it mean revert, if not overshoot, to outright undervaluation. And that should benefit EM. Wall Street's very expensive when we acknowledge where it's at in the profit cycle, and unwinding that could take years, during which time international equities are likely to outperform. We're setting up for a secularly strong era for commodities, but the best way to play that in EM is arguably through domestic-oriented companies in resource-producing countries. Whilst we think EM is somewhere to be raising allocations to, it's not necessarily China that stands out to us as the outstanding long-term buy and hold investment opportunity. with a few rare stock examples, China, we think, is best seen as a trade rather than as an investment. And instead, the really interesting places to be looking at for the longer term are countries that can benefit from the diversification of supply chains away from China, who are still poor enough to experience classic catch-up growth and increased penetration rates for things that we take for granted in the West, and where there's the potential for extended credit cycles and consumer upgrading. In our view, that's India, Southeast Asia, Central and Eastern Europe, and to some extent also Mexico. I'll finish there. Thanks very much for your time.
Great. Thanks very much for that, Ed. It was all very interesting. So we've had a few questions come through. Apologies if we don't get to all of them, but we are a bit short on time. So maybe to start with, there's a question sort of on macro. Basically, I guess the value of US dollars being put up by Fed policy because of rapid increase in interest rates. Do you see it as a sort of inflection point coming soon when basically there's a tightening or stops cutting rates? And I suppose what do you think the impact of that will be on EM?
Yeah, so in the very long term, it's valuation that matters most. Shorter term, there are obviously other factors at play. Last year, the strength of the dollar unequivocally was to do with a repricing of expectations for the Fed. So now we seem to be moving to a phase where potentially the Fed's not far off a pivot. That is something that you would expect to be negative for the dollar. On the other hand, it's also very clear, as far as short term is concerned, that the dollar tends to be a risk aversion beneficiary. That arguably is something which could still give it some support, even if at the same time we're increasingly assuming that the Fed's quite close to a pivot. Historically, the great periods of sustained dollar weakness tend to be once the US economy, or as the US economy's post-recession. So, perhaps we've still got to deal in the very, very short term with downturn risks, which might be somewhat, give the dollar kind of like one last hurrah. But once we get through that and we start to look at sort of a bottoming in the world economy, that's the moment when I think the dollar is most obviously likely to begin a more sustained downtrend.
Okay. The next question is on basically stuff happening around Credit Suisse. If banks retrench in the current environment and that creates a global recession, are you worried that EM is going to be or fuller fasting than developed markets?
So it's obviously negative for global risk appetite. It's obviously negative for global markets. I'm not going to pretend that it doesn't create a headwind for absolute returns for emerging markets. I would like to think that the valuation disconnect that we already observe between the market that's absolutely at the heart of any kind of US recession risk, i.e. Wall Street, and emerging markets offers some kind of buffer. It's not guaranteed, and certainly empirically, it's not a done deal that EM always underperforms just because it's a higher beta asset. That said, within EM, there are obviously areas that will be more sensitive and less sensitive. So we're actually quite light in North Asia, which is the much more export-oriented part of emerging markets. I'm holding fire on a wholehearted commitment to the commodity-producing block in EM for exactly the same reason. I tend to prefer near-term, slightly more domestic names. So I don't deny that that's a headwind out there. I'm not convinced that it means that we underperform, relatively speaking, and certainly for the active manager, that there are some things you can do to protect yourself.
Okay, and the next question is on something that you touched on briefly, which is basically the US trying to put pressure on China, restricting its access to, it seems, mainly semiconductors and other bits of critical technology. The question is basically, is China's increasing isolation from the West, do you see that benefiting any countries specifically, or do you think that creates any opportunities?
For sure. So firstly, it is important not to overstress your use of the word sort of China's increased isolation from the West. It is true that America is making it harder and harder for exporters of high-end technology to sell their product to China. But let's not pretend that the world is delinking from China massively right now. I mean, Chinese exports to America are incredibly close to their all-time highs. So we're not yet witnessing deglobalization, even if we fear it. And what seems to be happening to some extent at the moment is more that, and this is partly due to COVID as well as due to concerns about politics, multinationals are de-risking supply chains by creating multiple nodal sort of points rather than excessive reliance just on Guangdong. All that said, there are obvious beneficiaries, and I think that I've mentioned them. So we are seeing a notable upturn in multinational investment in Mexico. We're seeing major manufacturing companies setting up plants in India to exploit their cheap labor for export, but also to tap into the domestic market. And then Southeast Asia is also seeing decent levels of inward investment from actually as much from sort of the Japans and Koreas as it is from the States. So yes, that's part of my sort of thesis or part of my rationale for identifying the countries I identified as being the more obvious growth stories, that they are benefiting from this rejiggling of the global economy.
Okay, so I think I'll do this probably as the last question. I'm going to try, I'm not really sure what the person is asking you entirely. I think I get what they're going for, but it's effectively on the fact that if you look at most of the emerging market index, it's going to be heavily skewed towards China. At the same time, it tends to exclude some markets that arguably probably should be in the EM category. I think Vietnam, they haven't mentioned that, but Vietnam to mind comes to mind. I think you mentioned Vietnam as one country. I suppose the question is sort of on risks there and portfolio construction.
Well, I think I can. I think the sense of the question is probably essentially if we're not wildly enthusiastic about buy and hold China, and China's a large part of the benchmark. I mean, the obvious takeaway from that is it emphasizes the importance of active management and a fund that doesn't need to hug the benchmark as many do. And so I do think it is a problem for index trackers or for funds that are very, very similar to the benchmark in their composition, that they will be allocating their capital to the less interesting parts of EM on a multi-year view. What I like about our ability to be highly active managers with quite concentrated portfolios is that we can focus our attention on other areas that might get neglected. Specifically, Vietnam has the potential to be a very interesting place to go kick the tires. I certainly consider it part of my investment universe. I consider the whole of the frontier universe to be part of my investment universe, but it does have to be liquid. I offer daily dealing in my funds, and so the last thing I want is to be trapped in liquid assets. The other thing that Vietnam specifically needs to do is to resolve the problem of foreign ownership limits. That again, even if these stocks were more liquid, would constrain the ability to get properly invested at this moment in time. But hopefully Vietnam will open its stock market up in the next couple of years and make itself more investable for people like myself.
Okay, great. Well, Ed, thanks very much for taking time to do this. I hope everyone watching enjoyed it, and apologies if we didn't get to your question, but I've got much more time, unfortunately. So yeah, thanks again for joining us, and be sure to tune in again for the rest of the week. We have a presentation like this every day this week. So do join, ask your questions, all those sorts of things. So Ed, thanks again.
Pleasure. Thanks very much, everyone.